Hi everybody, welcome to the Attract Capital webinar series. I'm Janine. I'm here with Dave Barnett, CEO.
Hello everybody.
Today we're going to be talking about capital structure consequences of fast growth. So Dave, can you tell us about the different types of fast growth?
Sure, Janine. So the different types of fast growth, there's organic growth and there's acquisition growth. Those are the two main types of fast growth for the purposes of this discussion.
Okay, and then can you go a little bit more into organic growth?
Sure. Organic growth would be either new product growth where you've developed something new and you're launching it, or it might be a national rollout where you're expanding regionally across the United States.
Great. And then as far as these different fast growth rates, what is the increase of each type?
So with organic growth, we consider fast growth to be year-over-year growth of 20% or more, and with acquisition growth, we generally gauge it at where you're increasing the size of the revenue 40% or more over the prior revenue of the acquiring company. So 20% organic, 40% for acquisition.
And what happens when you achieve these rates?
So everybody thinks it's a great thing to achieve fast growth, and it is, because it's not an easy thing to pull off. But the issue is that it puts a lot of strain in your working capital, because when you grow faster, it's a use of funds. And you typically need more people, so your operating expense will go up. It may look like you are very profitable on paper. You might have a lot of profitability, you might have a lot of EBITDA, but you're very cash tight. And particularly after you come off of a period where you've had some losses or a tough period, which for most companies was 2020, it's harder to springboard with a fast growth rate because you may not have the level of working capital in the business that you would have otherwise had after a good year.
Okay, so then how would you recommend the best ways to change the structure so businesses can find more steady growth?
Absolutely, Janine. So it really comes down to expanding your capital bandwidth. And the best way to expand your capital bandwidth to accommodate this temporary situation of fast growth is to have transitional capital. That transitional capital can be mezzanine financing, it could be a form of growth capital, and it's really capital that you need on a temporary basis to fund the gap. You probably don't want to raise expensive dilutive equity capital. You may even be able to get by with a stopgap letter of credit, line of credit, where it's just a revolving line of credit. And a lot of our clients, when they get tight, their lender sees that they're embarking on this fast growth, but the lender can be collaborative and can also allow you to restructure the terms, could push out the maturity. Another thing you could also do is creatively source your inputs, and maybe some of your vendors have some more capital bandwidth, and you can push some of your capital consumption back to them through creatively sourcing some of your raw materials or creatively sourcing some of your labor. The key is to make sure that as you go through a transitionally fast growth period, that you have a lot of capital on hand and that you can handle it, because it's easier to hit the wall when you're growing fast than it is when you're contracting.
Good insight. So there you have it. Those are some consequences of fast growth and ways to transition through, and we'll see you again soon.
Take care, everybody.